Financial Planner. Follow us on YouTube.
Make it revealed. Just look at the clues. Let's get into the economic collapse financial news. Now, we're coming up to the end of the year. They're very low, but when we look at all the stats and everything around it, it doesn't make sense. Now, think about this. This year, 21 big retailers, they are closing hundreds or thousands of stores. And when we started out this year, there was an estimate that there were going to be, 6, 7, 8,000 stores that are going to be closing, and it's absolutely true. Now, Abercrombie & Fitch, they are closing 60 stores. Aerosols, which is a New Jersey-based women's footwear company, they filed for bankruptcy earlier this month, and they're going to be closing stores. American Apparel, that's a clothing store, they're going to be closing 110 locations. They also filed for bankruptcy. BCBG, they closed 118 stores nationwide. BB, this is women's apparel chain, they're closing 168 stores. Children's Place, well, they are closing hundreds of stores all over the place. CVS is closing 70 stores. Guess is closing 60 stores. Gymboree is closing 350 stores. HH Gregg, well, they went bankrupt, and the retailer is closing all of its 220 stores. J. Crew, they are closing 50 stores. Originally they said 20 to 30, and now they upped it to 50. JCPenney is closing 138. The Limited, 250 stores, and that cost about 4,000 people to lose their jobs. Same thing with Macy's. They're closing 68 outlets, and a lot of people have lost their jobs. Michael Kors closing about 125 stores. Payless closing 800 stores. Thousands upon thousands of people going to be without work. Radio Shack, as we know, they've closed about 1,000 stores. All they have left is about 70 right now. Thousands of people lost their jobs. Route 21, 400 stores. Sears, 300 locations. Toys R Us declared bankruptcy. They're closing stores. Wet Seal, this is teen fashion, they're closing 171 stores. And there's many other smaller retailers out there that are continually closing stores. And now this is moving into the fast food restaurant area. We know that Subway is closing stores, and this is going to continue on. And remember, just because people are using credit cards to pay for this holiday season doesn't mean that everything is fine, because that is not their own money. That is borrowed money with interest rates that are astronomically high. And many of these individuals who are out there doing this, of course, I know, they just want to have a very nice holiday season. Now, a good way to get a idea of what people are purchasing after the holiday season, you go around your neighborhood, you look at their garbage, and if they don't have a lot of boxes and a lot of things piled up for their children, things like that, where normally you see a huge amount of trash, well, they're not spending the money out there. They're not buying what they used to be buying. And there's a lot of retailers who are reporting that, this holiday season, the traffic was down, which we know is down around 4%, and we know that retailers are struggling. Now, of course, the corporate media is out there trying to make everyone convinced that everything is moving to online because online got a boost in people shopping online, and people spent more online. But you remember, even if this moves up to 15% of the total retail market, it doesn't translate from the brick and mortar, everyone moving to online. Remember, Amazon is only 3 to 4% of the actual purchases. So when we look at this, they can say it went from 3 billion to 7 billion, but that's meaningless in a $1 trillion business. Because what's happening is, online might have went up 4 billion, but the brick and mortar stores lost 60 billion. So, I'm just throwing these numbers out, but what does that really tell you? That tells you that it's meaningless what they're trying to say. This is why they always tell you, look, online business has boosted their sales by 4 billion. They didn't tell you the other side of all the losses. Now, they did this last year, the year before this, where they told you, look, online sales, $3 billion worth of sales. But they didn't tell you that brick and mortar lost hundreds of billions of sales, and it didn't translate. We know right now that the real estate market continually pushes up, and the housing prices are skyrocketing. We see Case-Shiller, in their latest data, is showing, out of the 20 cities, the housing prices have hit all-time new highs. Now, we need to understand something. Wages are not keeping up with this. Now, we're seeing this up in Canada, where this is a telltale sign that this is a housing bubble in Canada because it's out of the reach of the people. Here in the United States, we would see mortgage applications keeping up with the number of purchases of homes. And as the prices of homes go up in these 20 cities, and again, this is what they're controlling, the income in these cities, well, it's not keeping up. Now, think about this for a second. Let's put all this data into context. And when we look at the different cities like Los Angeles, San Francisco, New York, San Diego, we need to figure out how much household income needs to increase to afford these houses in these cities. In Los Angeles, it would have to increase by 122%. In San Francisco, 107%. New York, 95%. San Diego, 95%. Miami, 83%. Boston, 81%. Detroit, 61%. And guess what? When we look at the national average, well, it's increasing by 6%. There's no way that the American people can keep up with this bubble. And this is when bubbles pop. And we're seeing it in Canada, and we're going to see it here in the United States. We know we're in a bubble. The Fed knows we're in a bubble because the Fed has done this before. You have to remember, this is the 5th rate hike since the Fed embarked on its policy tightening in December of 2015, and the 4th rate hike in the last 12 months. Now, the Fed's latest statement also indicates it plans on raising rates 3 more times in 2018. Now, when we look at this, people say, not a really big deal. We've seen this before. But the Fed's actions are very unusual. Other major central banks, this is the Swiss National Bank, the Bank of Japan, European Central Bank, and Bank of England, well, they're all currently running QE programs. The Bank of Japan, ECB, Bank of England, they're printing money. They're creating new money to buy stocks outright. What is the Fed doing? The Fed is tightening when other banks are all creating new money by the billions. Now, the following quotes from the Fed, they offer us some clues on what is really happening here and what they're really doing. If we look at June 2017 from the Fed Monetary Policy, forward price to earnings ratios for equities have increased to a level well above their median of the past 3 decades. Fed minutes from July of 2017. Since the April assessment, vulnerabilities associated with the asset valuation pressures has edged up from notable to elevated. As asset prices remain higher or climb further, risk spreads narrowed, and expected and actual volatility remained muted in a range of financial markets. Now, Janet Yellen, in response to a question from the IMF panel on October 2017, said the following: market valuations are at high level in historical terms when assessed on metrics akin to price-earnings ratio. Fed minutes on October 2017. In light of elevated asset valuations and low financial market volatility, several participants expressed concerns about a potential buildup of financial imbalances. Janet Yellen during Fed presser December 13, 2017, stock valuations are at a high end of historical levels. Now, the Fed's primary role is to maintain financial stability. This means that the Fed will always downplay risks in its public statements. And we've seen this with Ben Bernanke, where, if we go back in time, he once stated that the Fed policy is 98% talk, 2% action. With all this in mind, the above quotes are astonishing in their clarity. The Fed is explicitly stating, in Fed terms of course, that the markets are in a bubble. And the Fed didn't just do this once. The Fed has been warning about asset valuations for 6 months straight. So how bad is it? Well, we're back to 1999 levels. That's how bad this bubble is. The S&P 500's current PS multiple has surpassed its former all-time peak from 1999, a period that is now widely considered to be the single largest stock bubble in his history. Put simply, stocks are extraordinarily overvalued by a reliable measure. And this tells us that we are headed towards major problems. And we can see it with the real estate bubble. We can see it with retail stores closing. We can see it with the fake unemployment numbers. We can see it with the fake GDP numbers. And we can see it with the fake stock market, because we know that central banks are printing like crazy to keep the market up, because they know if that comes down, they're screwed. Now, what's very interesting is that Saxo Bank is out there, and they're saying that China, they're going to take away the reserve currency of the petrodollar, and the petro-yuan, well, is going to be the new go-to currency for oil. Now, let's think about this. The world's largest crude oil importer, China, is likely to roll out the petro-yuan next year, like we've said many times, because they've done their tests, and after Christmas they said they're going to roll this out. We know that Russia will gladly accept the yuan to phase out the dollar in trade with China. China is by far the world's largest oil importer, and many producer nations are already more than happy to transact in yuan terms. And Saxo Bank expects the Chinese yuan denominated oil contracts to be a move with tremendous geopolitical and financial consequences. And this means that everything is going to be moving towards that direction. And we need to remember something very important here, is that this whole system was based on having the dollar attached to oil. And we know that this is falling apart right now. Now, Trump released the new 55-page American First National Security Strategy document. And Russia and China are mentioned in this document. Many other countries are also mentioned. But when we look through it, what is at the heart of this? Well, it's the Russia-China threat to the US dollar. They know it. They know that the dollar is dying. They know that Russia and China are a threat to the reserve currency. Now, in the document, it defines Russia and China as revisionist powers, rivals, and for all practical purposes, strategic competitors of the United States. And we see right now that with the development of the petro-yuan, the petro-ruble payment system, and the Silk Road, also known as Belt and Road Initiative, BRI, this is a whole new economic system. Now, gold is essential in this strategy. Russia, China, India, Brazil, South Africa are all either large producers of consumers of gold or both. Following what has been extensively discussed in their summits since the early 2010s, the BRICS countries are bound to focus on the trading of physical gold. And this is why they're looking to set up a physical gold trading system by 2018. Markets such as the COMEX actually trade derivatives on gold and are backed by an insignificant amount of physical gold. Major BRICS gold producers, especially the Russian-China partnership, plan to be able to exercise extra influence in setting up the global gold prices. Now, there is hidden riches in the Belt and Road Initiative. There was a report that was released by DBS in Singapore, and it hits most of the right notes linking the internationalization of the yuan with the expansion of BRI. In 2018, 6 major Belt Road Initiative projects will be on overdrive. The Jakarta-Bandung High-Speed Railway, the China-Laos Railway, the Addis-Ababa-Djibouti Railway, the Hungary-Serbia Railway, the Malacca Gateway Project in Malaysia, and the upgrading of Gwarda Port in Pakistan. HSBC estimates that the BRI, which is the Belt and Road Initiative, as a whole will generate no less than an additional game-changing $2.5 trillion worth of new trade a year. $2.5 trillion worth of new trade a year. Now, it's important to keep in mind that the Belt in BRI, Belt and Road Initiative, should be seen as a series of corridors connecting eastern China with oil, gas-rich regions in Central Asia and the Middle East, while the roads, soon to be traveled by high-speed rail traverse regions filled with, what else? Unmined gold. Now, yuan-denominated gold contracts will be traded not only in Shanghai and Hong Kong, but also in Dubai. And we will know when it's really game over when Saudi Arabia, the House of Saud, officially announces it accepts yuan for at least part of its exports to China. And the European report points to what may be the Chinese trump card, an authorization to issue treasury bills in yuan by Saudi Arabia, the creation of a Saudi investment fund, and the acquisition of 5% share of Aramco. And we can see right now that we are definitely heading into an area where this collapse of the old system, which is the dollar, and the birth of a new system, well, it's all happening at once. And we can see from this national security document the strategy and what is really happening, and what they know is that this is actually moving from west to east. And they pointed out in this document that yes, China and Russia, they are competitors. And eventually what's going to happen is everything will move from west to east, and we're going to go through this major transition. And we see that the economy of the West is really rapidly falling apart. Yes, on the surface with the corporate media, with Trump and everyone else out there telling you the stock market's doing great, it's very difficult to see this. Go back to 2008 when the market was hitting 14,000 points. Very difficult to understand what was happening until the market came down. And once the market came down, then the truth came out. All these corporations, they're having trouble. The automobile manufacturers, they're going to go bankrupt. AIG, which is attached to all these different corporations, they're going to go bankrupt. The whole thing was built on an illusion. When the market finally comes down, you're going to see the truth come out. That all along, this whole thing was built up on a gigantic illusion. You'll see what the Fed has been doing. You'll see what the other central banks have been doing. And of course, they don't want people to see this. And this is why they need some type of distraction. Because if people realize what the central banks have been doing, people are not going to want the central banks. So we see that we're heading into this area where things are rapidly falling apart. China, Russia, other institutions already realizing where the next powerhouse, where the next reserve currency, where everything's going to be. It's going to be out in the East. It's already been built. The infrastructure's already there. It's already set up. And it's just a hop, skip, and a jump until everything just moves right over to there and the transition begins. The transition has already begun. People just don't realize it as of yet, because they like to do this with some type of distraction, so you don't really know what's going on. But this has been happening for a very long time. This is why you need to be ready and prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.